Welcome to Market Call. I'm Morella Fernandez. Mike Vinokur on the show with us today. He's portfolio manager and senior wealth advisor at Propellus Wealth Partners, IA Private Wealth. And he's going to take your questions on North American large caps. Here's how to reach us. 1-855-326-6266 if you'd like to call in. You can also email your questions, marketcall@bnnbloomberg.ca. Mike, thanks for coming in today. Good to see you.
Pleasure to be here.
Let's talk about the enthusiasm in the markets. The TSX still seems to be hitting these record closes, did last week. Why do you think that is?
Well, I think that when you decompose the TSX, you've got a lot of gold, silver, mining complex. You know, gold has been on a huge run. Silver is now starting to catch a bid. We'll see if that continues. The banks have been doing reasonably well. You've got the tech sector. And you know, the TSX is not as, the TSX companies, I should say, are not as related to the domestic economy in Canada as, say, for example, other markets like the US, where more of the earnings are directly related to the domestic-focused economy. So I think that it's sort of a catch-up trade.
Okay. So I know you've also mentioned some softening in the economic outlook, generally speaking. Tell me where you're seeing that.
So we're seeing that in Canada more pronounced, in our view, than the U.S., though you're definitely seeing a slowdown. I think the markets for now have been sort of camouflaged, if you will, by the fear of tariffs, especially in the U.S. And so you saw a ton of importing coming in ahead of tariffs, so lots of buying, lots of inventory stocking. Now you're probably going to see that sales turn into GDP numbers. So the GDP in the U.S., for example, of Q1 was reported at a very small negative 0.3 or something like that, maybe revised, we'll see. But Q2 is probably going to be hugely positive because now you're going to have what was taking away from GDP, which is the net import number, more than likely come down. And then we'll see in the back half of the year how consumers are reacting, how businesses are reacting, what the geopolitical situation is, and how the money is going to flow.
We had unemployment numbers up slightly in this country. I'm wondering what else you see moving forward for Canada.
So we think that there's going to be some kind of tariff resolution, but it may not be what we were used to in the past.
Canada specific or global?
Global.
Okay.
I'm hoping that we, as the friendly neighbors in the north, are going to get that better deal that we had under NAFTA. Who knows? We don't know. But we do see some pain, regardless of what happens, because we think that companies are just going to become more efficient, more lean, implement more AI. You're seeing that both sides of the border regardless. I think the tariff situation is jolting businesses into trying to cost cut and get more efficiencies out of their enterprise.
Got it. Okay, we're going to take a quick break. We're going to be back with Mike. He's a Propellus Wealth Partners, IA Private Wealth, taking your questions on North American large caps. Here's how to reach us. We're back in a moment. Welcome back. Mike Vinokur is with us today to take your questions. The first one through an email from David. He says, thoughts on Visa. Let's bring up the chart for Visa and take a look at that. A company historically that has done well. Even in a downturn, these companies seem to do well.
Yeah, so Visa is a very interesting animal because they don't have any credit risk, right? They own the technology that processes transactions, end of story. It's basically a technology business, and it's very high returns on capital, but it's also a very expensive stock. I think the price to earnings ratio on this thing is somewhere in the 30 range, last time I checked. We think the business is extremely solid, and in fact, funnily enough, an inflationary environment actually helps them because inflation increases prices, and so the overall gross volume of processing goes up by inflation, not because people are actually buying more items, they're just paying higher prices.
Yes.
Yeah, and so that higher volume, actually, they get their take rate, whatever that take rate is. For us as a value investor, though, it's a very expensive stock, and you have to continuously believe that not only are they going to grow at X, but also that you're not worried about any disruption. And in our view, we've seen a lot of disruption come into the payment space, and I wonder if slowly but surely they're chipping away at that huge moat called Visa.
And I was wondering previously why that hasn't happened already, given how many advances and how many players there are now. No one's really taken over.
Well, I think it's probably because think about how many Visa cards are actually issued worldwide. I mean, you're talking about changing the mentality of the class that arguably controls most of the wealth, which is the older population. Mm-hmm. The older population grew up with Visa. It's like synonymous with payment card, right? So it's going to change, I think. The question is, how fast will it change versus the growth in their business, and can you make the rubber meet the road on valuation?
Got it. Okay, let's go to the phone lines. Jack's on the line, calling from Montreal today. Hi, Jack.
Hi, how are you?
Good, thank you. What's your question?
I have a question about Parkland. Is it a buy or sell?
Okay, thank you for the question. Parkland, a lot feeding into this if you want to sort of expand on the situation they're in.
Absolutely. So full disclosure, we own Parkland. Okay. We've owned it for a little while. We think that the takeover offer is going to go through. So if you are a believer, and by the way, I should note that I believe last Friday, the largest shareholder in Parkland has accepted to vote with the offer, which I think was a reasonably big hurdle. So now, if you believe that the offer or the deal will go through as is, you're talking about a $44 price tag. So if you want to buy the stock here to hopefully capitalize on that $44 price target, if you feel comfortable that it's going to go through, that's not a bad trade. But I would say it's probably not a long-term investment because chances are this company is getting taken out.
Got it. Okay, so if you want just that uptick from the buy and you're hoping that goes through, now would be the time to get in. Okay, let's go back to the phone lines. John's on the line from London, Ontario, with his question. Hi, John.
Hi, Marilla. Hello, Michael. Yes, the irrepressible Visa. I would agree with you completely. What about the Mag 7? I've been watching them over the last especially 8 or 9 months, and they have similar curves, but I think some are starting to emerge, such as Microsoft and Meta. What do you think about Meta for an ad and about an 18-month hold? Thanks very much.
Okay, thank you for the question. Here's the Meta stock at $778, up $3 today. What's your forward look on Meta? They're all sort of battling in very different arenas on very different fronts. Yeah.
Thanks for the question, John. There's nothing bad that I could say about Meta. They've been executing very well. We used to own it and sold it way too early, not understanding how much of a accelerant could occur if the market understood what Mark was trying to do, and also if he agreed to cut spending on his metaverse investments, which I believe has happened now. This is a cash flow machine. The two things that I think would be or should be on any investor's mind in this stock is, one, with the normal business cycle, so if you believe we are going into a slowdown or into a recession, ad spending generally tends to go down. Mm-hmm. And Meta's main bread and butter for earnings is ad spend, right? So that's one. And two, its valuation is reasonably full, unless one can believe that somehow in their AI investments, they're going to gain such a big edge that their growth trajectory in earnings is just going to continue at that 25-30% per year clip. We're not there yet. And so I would not be, as a value manager, not be chasing this at this price.
Got it. Okay, let's move on to another phone call. Anne is calling from Scarborough, Ontario. Hi, Anne.
Oh, hello, Marilla and Michael, M&M. Michael, may I please have your outlook for UNH, UnitedHealth? Thank you.
Thanks. They've also had a lot of problems. They kind of missed on where they guessed what would come in with Medicaid, I guess. Medicaid.
Well, I think that's not the only issue. I think with UnitedHealth, you're, pardon me, you're battling two major issues. One, there's concern that they were actually paying nursing homes to not send patients to hospitals. Yes. Now, I don't know if that's true or not, but sometimes where there's smoke, there's fire. So that's one. Two, there is a possibility, given the shooting of their president and the allegations that, in the U.S. business, they were trying to not pay claims or delay, right? So I think this company is eventually going to be okay. But in the short term, it's got a lot of hair, and there's like a likelihood, in our view, a lot more bad news coming out, and that may shake out a lot more investors. In the long term, if you can hold your nose, close your eyes, not worry about it, and not look at it for 3 years, you probably, I think, will do okay. But in the interim, the whole space looks like it's in the ire of the U.S. government, trying to cut costs, trying to, decrease costs on drugs, maybe go after the HMOs. By the way, one other thing is that UnitedHealth owns what's called a PBM. And the U.S. administration has, in fact, said they're going after the profit margins of PBMs to reduce the cost to the government. So I don't know necessarily how that eventually will impact their profit margins.
Some would argue they're such a big player, they can't fail. Do you agree with that?
Well, it's not about failing or not failing. They can not fail, but then have such a reduction in their profit margin or be mired in so many charges that, the recovery is going to take a long time. And I guess the only company that I could point to that had a similar fate was Wells Fargo way back when in the day. Huge, couldn't fail. But my God, the stock did nothing forever and a day until finally in the last little while they were cleared, and now it's had a great run.
Yeah. All right. We do have to take another break. We're going to line up some more phone calls and emails for Mike. We're back in a moment. Welcome back. Thanks for joining us on Market Call. We're going to an email right now from Sly. He says, is Walmart a place to, right now, I guess, as a place to invest? We'll pull up Walmart and see how this company is doing. A lot of companies, of course, were hit by consumer confidence in the middle part of this, the last few months, we'll say, worried about what a downturn in the economy. That being said, places like Walmart and Costco would still, I imagine, do well.
Yeah, so I think the business is going to do well. The question is it a worthwhile stock investment, right? There's no doubt in my mind that Walmart is an extremely well-run company. They have a huge footprint. Nobody's going to come in and dethrone Walmart. The question is, given the cost of employment, given the tariffs, and so the cost of shipping in goods from overseas, you now have potentially a U.S. dollar that's going down. So, Walmart imports a lot of their product. How is the U.S. dollar going down plus any type of tariff going to wreak havoc or not on their prices, everyday low prices, as they call it, to their customer, right? And what is that going to do to profitability? So for us as a value investor, Walmart is a little bit on the expensive side. I think it's also trading at 30 times earnings, something like that. I guess, given the fact that it's the one and only, other than Target, let's say, which is a much smaller competitor, and Costco is a one and only business, people can argue that, hey, they're just going to keep on growing their sales, growing their earnings, buying back their stock, and eventually, grow earnings per share. We don't know when eventually happens, and we don't necessarily want to wait for the disconnect and that margin of safety.
Got it. Okay, so let's go back to the phone lines. Rocco is on the line from Montreal with his question. Hi, Rocco.
Good afternoon. My question is on BCE, our old telecom sector that's been beaten down in the last years. What is your take on BCE short term? Is it time to accumulate, or do we stay on the sidelines and still wait for some better news? Thank you.
So BCE, of course, parent company of Bloomberg News under the Bell Media brand. Telecoms have been beaten up quite a lot.
Yep.
BCE is trying to sort of switch its business focus. What is your take? In the meantime, the stock has been hovering around $30.
So I think if one wanted to take a stab at BCE, now is probably the time. It's been basing at this level or below this $40 level, which, it broke a while ago. I think at $30, it's reasonably cheap. I like the fact that they cut the dividend. Mm-hmm. It gives the company a lot more financial flexibility to pay down debt. And I think that now at this valuation, the fears that the market had are perhaps a little bit overblown. Plus, utilities generally tend to trade somewhat with interest rates. And if you believe, as we do, that interest rates are going to trend lower, at least in Canada, the dividend yield that it still pays is quite high. And I think now reasonably stable, no matter what happens. So I don't foresee another cut of the dividend. So here you can buy the stock at 30, collect the yield, I think is 6%, somewhere there. And I think over the next couple of years, you may see a reasonable recovery. We do not own BCE. We own Rogers, who has also suffered in tandem with TELUS. But again, we think that right now is probably, if you have a 2 to 3 year view, is probably not a bad time to get a position in the telcos.
So some people are going to jump in. What about those who are holding? We've had a lot of calls about people who say, I've held the stock for many years. Obviously, it did very, very well and then started moving down. Should they hold on?
Well, our view is if we would tell somebody to buy something, then we would also tell somebody to hold it.
To hang on.
Yeah.
Okay.
I mean, at this price, if you've held on through this whole downturn, I don't think it's necessarily the right move to sell. The only time I would maybe say that is if you need a tax loss and there's a tax benefit to selling and maybe you want to wait the 30 days to repurchase it. But yeah, at this point, I think you're better off holding than selling.
Got it. All right, we're going back to the phone lines. Ray's on the line from Kingston, Ontario. Hi, Ray.
Hi, thank you for taking my call. Mike, my question is on the Toronto Dominion Bank. It's had a really good run for the last 3 to 4 months, and I'm wondering if you would be adding at this price level. I think it's 94 and change right now. Would you be adding at this price level, or do you see a pullback with TD Bank or Canadian banks in general in light of what's happening with the housing market? Thank you.
That's a great question, Ray. Thank you. I would be waiting for a pullback. There's nothing wrong with TD Bank. It's a great operation, but you are typically coming into the seasonal period where Canadian banks don't necessarily do well. We just finished the earnings season where they've told you what has happened, but to Ray's point, there are a lot of mortgages maturing. We are going into a potential slowdown. We're probably going to see more job losses, higher unemployment rates ticking up. You've seen the banks reserving, and I just don't know if we are at the midpoint of the credit cycle or if we've even entered close to the midpoint. We have a sneaking suspicion that the credit cycle is going to endure for about another year. So maybe at the end of this year, will we be at the midpoint, looking over the horizon into 2026, 2027, when the provision for credit losses are going to start maybe coming down and they've already over-provisioned and some of that provisioning can come back into earnings.
Got it. Okay, so a bit of a wait if you're looking at TD Bank. Okay, let's go to Alan from Georgetown in Ontario. Hi, Alan. What's your question?
Hi. Thank you for taking my call. I wanted to ask about Amazon. I wanted to know, what's a good entry point? And I just wanted to know, do you think if these tariffs are going to be implemented and there's a little bit more certainty with China and the rest of the world, is Amazon's gross margins or profit margins going to be affected? And if you do see a higher unemployment, do you see that the consumer is going to go more to like Walmart, or are they actually going to, and they're going to lose a lot of consumers like Amazon itself? Or do you think that actually more consumers would be purchasing products on the Amazon because of their price competitiveness? If you can keep me on the line as well so that I can hear the answer, that'd be great. Thanks.
Okay, so let's talk a little bit about a couple of things. First of all, Amazon has not fully recovered from the dip in April. Part of that might have to do with what it's bringing in and the tariffs that it faces. But his question has to do with also, can anybody compete with Amazon? And Walmart has its online service, but I don't think they do the same thing that Amazon does.
Right. So I think Amazon has quite a few different businesses. Some of them are extremely high margin, and some of them are much lower margin. I also think that Amazon is more of a fulfillment business than it is a product selling business. You've got a lot of sellers that sell on Amazon, and Amazon allows them to store the goods in their warehouses or advertise on Amazon and then, have the delivery business or the fulfillment or the credit or the whole package, right? And I believe Amazon just charges a fee. I don't know if it's a flat fee or a percentage. So I don't know that Amazon is going to be hit by tariffs. I think a lot of it is going to be the sellers that are going to bear the brunt of having to pay a higher cost for the product that they import from wherever it is that they import.
And do you think they'll absorb it as opposed to passing it on to the consumer? Because that's the question, right? Is the consumer going to pay that price?
Yeah, I'm not sure that they're going to be able. Well, I guess it depends where they're importing from. If they're importing from a country like the UK, for example, where maybe the tariff is only 10%, then maybe they're going to be able to absorb it. But if they're importing from a country, let's say like China, where if, let's say, the end tariff ends up being at 30 or 40%, who knows, then I don't know if they'll be able to absorb it. I guess it just depends on their profit margin.
Okay, so not really another competitor with the way that it operates. Does it have some comeback room? I mean, it clearly has that room. Will it continue to close that gap?
Yeah, so from a stock perspective, Amazon is not very cheap, but wow, does it have growth? And does it have an unbelievably good management team? Absolutely. This is a company that keeps on innovating. So if you have a very long-term time horizon and you want to take a position, you may want to take a position now. We would like to own Amazon, but at a lower price point. So we have our eye on it, but we'd like to see a pullback first before we enter.
You're going to wait. Okay. When we come back, we'll have a look at Mike's past picks. We're back in a moment. Welcome back. Time now to take a look at Mike's past picks from May 9th of last year, so May 9th, 2024. At the time, he chose Johnson & Johnson. We'll pull up that chart and take a look at where it was at the time. Recommended at $149.85 American, and now up to $155.02, so a 3% upside return and 8% total return. And you mentioned you actually sold your position in Johnson & Johnson this year.
Yeah, in March. We sold it at $168 or so.
And why did you do that?
A few factors. One was the fact that the earnings estimates were coming down based on what we saw in terms of the future. Two, we refined our model on free cash flow and decided that there were better places to park our capital. And three, our fair market value as a result of our model came down a little bit, and so we thought the margin of safety just wasn't there anymore. Plus, Johnson & Johnson is in that whole healthcare space that was, to a degree, being attacked by the government, and we just didn't know where their own margins may end up, given the price fighting, if you will, on drugs and other things related to healthcare.
Got it. Okay, let's get to your next past pick, which was Rogers Communications in May of last year. At the time, it was $53.82. It's now dropped to $36.74, a 32% drop return, 27% total return drop. And we've talked a bit about the telecommunications, and they've been hit, as well as it spent a lot of money buying some sports products.
Yes, absolutely. We still like Rogers, and we think Rogers is a bargain here. If we didn't already own it, we would be buying more. Or we would be initiating a position. We think that two things are going to help them or provide a tailwind. One is the fact that there's a lot of immigration in this country. And, the latest figures we saw was that in the first 4 months, there were 800,000 newcomers to Canada. Many of those people need a device. And so one of the 3 or 4 telecom incumbents should benefit from, the net immigration numbers, number one. Number two, I think there's cost cutting going on at Rogers, which I think they will benefit from. Also, implementation of new technologies, which will allow them to enhance service and cut costs. And 3, interest rates. As I mentioned with BCE, this is a utility. They pay a nice dividend. They're, by the way, not overpaying the dividend. They're very comfortable generating a lot of free cash flow. And we think that over the next 3 years, the tailwind of more customers, technology, cost cutting, and refining of their balance sheet is going to help.
Got it. Okay, let's get to your last past pick from May of last year, which was FedEx. At the time, it was $262 American, now down to $222, a drop return of 15% and total return drop of 13%. What's been happening with FedEx?
So I think FedEx, like UPS, you've had people worrying about a couple of things. One, a drop off in demand, and 2, cost considerations. And in the beginning of the year, the price of oil was a lot higher. The price of oil has since come down, though the stock price hasn't really rebounded to its former glory. I should add that we sold the stock at $295 back in November of last year. So thankfully, we have not participated in this downtrend. Still like the company very much, and actually it's back on the potential buy list. Should it get down to a bit of a lower point there it is today.
Got it. Okay. We are going to take a quick break. We're going to have Mike answer more of your questions on North American large caps. When we come back, stay tuned. Welcome back to Market Call. Let's go to a phone call from Ben. He's on the line from Kingston, Ontario. Hi, Ben.
Hello. Thank you to both of you for taking my call. My question is on Boeing. Have they endured pure pain and they are back in business? What is your opinion on the fundamentals of Boeing going forward? Thank you, and I'll listen to your answer. Thank you.
Okay,
Bye-bye.
Thanks for the question. So Boeing had a lot of trouble, and do you think they are past their problems that they've had with the accidents and the pieces falling off and all of that?
I hope so.
Okay.
Thanks for the question, Ben. Boeing is an interesting business because there's really 3 companies in the world that make planes, right? Embraer, which is a smaller player, Boeing, and Airbus. And, we hear all the time how global travel is growing. There's just more people in the world that want to travel. We have an aging fleet. They both, I believe, have been mired still to this day by logistics issues in terms of their supply chain. To your point, Boeing had the 737 MAX issues. They've had a few crashes. They've had some worse than slaps on the wrist by the Transportation Safety Board. I believe there's been some change in the management suite. And the challenge with Boeing as an equity investor is they're carrying a lot of debt. They had to take on a lot of debt during COVID. And because of the delays, because of the crashes, because of all of these things, it's been hard for them to, eke out a very good positive cash flow. Having said that, their order book is pretty filled up.
Yeah.
So if management can figure out how to gain efficiency, get behind all of these issues, prove to the airlines that they're back better than ever, then I think this company is going to do well. I'm just not sure that it's there. And so you have to be very patient with this equity, holding it for the long haul.
Okay, so when you say long haul, it's going to be a number of years before it's sort of clear of everything?
Yeah, and you don't wait until it's clear of everything because by then it's too late. But I'm not sure at this point if you could see the light at the end of the tunnel just yet as an equity investor to own this stock.
Got it. Okay, let's move to the next caller. Glenn is calling from Toronto. Hi, Glenn, what's your question?
Hi, thank you for taking my call today. I would like to know about Pfizer, given that I've just heard your opinion about Johnson & Johnson, and I've already taken that into consideration. What do you think of Pfizer as a value proposition, given that the dividend on it and the PE value for a 5-year hold?
Okay, thank you for the question. So a lot of the pharmaceutical companies have not been doing well. And some of it is sort of post-COVID and the expectations around that, which shot all the stock up. What do you see as a trend for some of these companies?
Well, I can't talk about the whole industry, but Pfizer, so full disclosure, we did buy Pfizer right around the time when there was an activist investor that entered the stock. We did think that maybe there would be a turnaround, and we did sell it not too long ago and took a loss. And the reason we did that is because we changed our mind and came to the conclusion that this is a Titanic ship that's going to take a long time to turn around. The the free cash flow is not very abundant, and they have a ton of debt that they took on. So while they did very well during COVID because of the COVID shot, when you look at the rest of their portfolio, in light of the fact that they have a lot of debt, in light of the fact that they don't generate a lot of free cash, they are paying out a huge dividend, and the drug prices may be forcefully reduced on them, we decided we just didn't want to be part of the story anymore.
Got it. Okay. Let's go to Kareem. Kareem is on the line from Ajax, Ontario, with his question. Hi, Kareem.
Hi, thank you for taking my call. My question is on CNQ, and I would like to request your guest's opinion on CNQ, if you would consider this as a buy, hold, or a sell at this point. Thank you so much.
Okay, so Canadian Natural Resources, pulling up that chart now, it's at 43.31 today, just a little bit up, 6 cents. What is your forward take on this company?
So we think it's a very well-managed company, and we are bullish on energy prices going forward.
Oil and gas.
Oil and gas. More so gas as a percentage than oil, but both. And I think there's nothing wrong with buying CNQ if you don't have a lot of oil and gas exposure today and you're looking for a very solid name. This is a very, very good management team. They've got some solid properties. They've done a very good job over the long term. And I think that right now, because of drill, baby, drill, or, whatever the reason is, people soured on oil and gas stocks. We think that this is a tremendously well-run company, and we think you'll do well in the future. Just to note that you've now recently entered the period of seasonal weakness for oil and gas, which typically lasts until July, August, at which point it picks up again. So, whether you want to wait to accumulate a position a little bit for a pullback or whether you just want to buy some now. But if you have a very long-term time horizon, I think you'll be okay with it.
Got it. Okay, let's go to another caller, Dominic from Montreal, with a question. Hi, Dominic.
Yes, hello. Thank you very much for taking my call. It's about Alphabet. It's a specific question, Mike. Alphabet started developing the cloud in 2008 or so, and it was only 15 years later that they were reporting significant earnings from the cloud. And Waymo has now been in development for about that long, 15, 16 years. I don't want to oversimplify it, but do you see Waymo as starting to add to Alphabet's significant earnings, and What are your thoughts about the competitors in autonomous vehicle space?
Okay, so does Waymo have that much gas to jump ahead and pull the stock in any way?
Right. So I don't think that Waymo is going to be adding to earnings anytime soon for Alphabet, because I think that there's a substantial amount of capital that has been poured into Waymo, and potentially a lot more that will need to be poured to expand the footprint. I think Waymo is only operating right now in a few jurisdictions. It's going to take time for them to map out. I mean, it's impressive, by the way, just to say that if they could map out a city like San Francisco with its hills and up and down and trams in the middle of the road, then probably cities in Arizona or Texas where it's more flat and less bumpy, let's just say, is probably a lot easier. Having said that, I have no idea what the adoption rate is or is going to be of an autonomous vehicle, let alone the profitability. So I think you have to look at Waymo as sort of this net asset value play in the conglomerate of Alphabet and leave it at that, as opposed to thinking that it's actually going to add to earnings at this point in time.
Got it. Okay, we are going to take a quick break. More of your phone calls and questions in just a moment. Welcome back, and thanks for joining us on Market Call. Let's go right to the phones. JP's on the line from Edmonton right now. Hi, JP.
Hi, thanks for taking my call. My question was about Apple. I'm just wondering whether it's a good entry point or not. Thank you.
Okay, let's look at where Apple is right now, 204 almost, and not recovered from that April slide down, also facing a lot of tariff challenges, right?
Yeah. Thanks, JP, for your question. Look, Apple is a great brand. I myself have had an iPhone for, I don't know, I guess since they came out or shortly thereafter. And so do all my kids. So if that's any consolation. But as an equity investor and as a value manager, there's not enough margin of safety for us in order to buy a stock like Apple today. Apple trades at something like close to 30 times forward earnings. And yes, there is a bigger and bigger component of Apple that's from services and recurring revenues and subscriptions and, all of that kind of stuff. And that's great. And they are working on some AI features which may bring in at the margin more revenue. But to my knowledge, the bulk of their earnings still come from selling a piece of hardware. And that piece of hardware does not have nearly the same amount of margin, number one. Number two, if President Trump has his way and they have to be built in the U.S., well, that margin is going to go way down. If they have to move their production to somewhere like India, well, then I would argue that, to ramp up the experience, I think they already produce their
They've already started moving some of that production to avoid the tariffs on China.
But I don't know if, you move manufacturing, you have to train people. Is the quality, is the volume going to be the same? So are the costs going to have to go up to maintain the quality? I just don't know. There are a lot of factors. But even if you could say that, everything will be fine, at 30 times earnings, we love the company, not the stock.
Got it. Okay, let's go to an email from Duncan. He says, hello, can you please provide commentary on Brookfield Corporation?
Thank you, Duncan, for your email. So Brookfield is a storied asset manager that owns what I call many baby Brookfields. We like the company very much. We think the management is phenomenal. We just think that it's expensive for what you're getting. And we think that you want to wait for a pullback. We're concerned right now about the whole private equity space and about the potential mark to market in both private equity and private credit. We don't know what's going to happen when defaults or lowering of valuations happen, and what that's going to do to marking of books, and then what that's going to potentially do to asset management fees. And so these companies have had tremendous runs on their stock prices, but I think that for us as a value manager, we need a decent sized correction in order to give us that margin of safety to enter a business like Brookfield.
Got it. Okay, we are going to leave it there for questions today, but stay tuned. Michael will share new top picks after the break. Welcome back. We are going to take a look at new topics from Mike. His first one is Dental Core on the TSX. This company buys up other dental practices, I guess, and there's some synergy there?
That's right. So they now own something like 570 dental practices. To put it into perspective, there's 15,000 or so dental practices in all of Canada. They have done a meticulous amount of data work to figure out, based on their metrics, how many of these practices would they want to even engage with, and then drill down to even more, how many would they even want to acquire. And right now, based on their latest presentation, they're in talks with approximately 150 practices. They've been acquiring quite consistently over the last 3-4 years. They just initiated a dividend, which is generally speaking a very good sign that management is confident in cash flows. They're generating quite a bit of free cash flow now. Interest rates have gone their way because they do carry debt for all the acquisition of practices. But now we think that they've gained so much scale that they're going to be able to grow organically through free cash flow. They're going to be able to reduce costs, increase gross margin. They're deploying some AI technology, which is going to help not only their practices with their revenues, but also better patient care, hopefully for all of their patients. So, and they're by far and away the largest dental practice owner in Canada. So you would think that if anybody has synergies, it's them.
And are there others who do a similar kind of thing?
Very, very small, and to my knowledge, not publicly traded.
Got it. Okay, let's get to your next new pick, which is IAC, which is essentially, I guess, a holding company. They buy, they own a number of different brands.
So they own different businesses, and they've developed businesses over time and then spun out businesses. So one of the most popular is Expedia. You know, they were behind the Expedia launch, and then they sold it, and now it's its own publicly traded company, or spun it out, if you will. They spun out a company called Angie, used to be called Angie's List. So they controlled it. It was public, but they controlled, I think, 70 or 80% of the shares, and they spun that out to shareholders. And today what you're getting in IAC is you're getting a company that owns a ton of stock in MGM Resorts, so the big casino, BetMGM, hotels, and all of that stuff. Then you're getting cash on their balance sheet. It's a really clean balance sheet. And then you have a couple of operating businesses. One is called Dotdash Meredith, which owns quite a few media properties. You have another business called Care.com, which I believe is in the nursing care business, helping nursing homes acquire highly trained people and helping people care for their families, et cetera, that kind of thing. And then you've got a few smaller properties, and then they own 32% in Turo, which is like the Airbnb for cars.
Okay.
So a really interesting compilation of businesses, but at the end of the day, Barry Diller is an icon in the business, an extremely smart guy, great management team behind him, and a very low valuation, we believe.
Got it. Okay, let's go to your third pick, which is Synovus. So oil and gas producer, refineries. Oil, of course, the prices dropped a lot and dropped many of the stocks, including this one, but you like it moving forward.
Yeah, so what you get with Synovus is you get very long life reserve index, right? Because of their oil sands and thermal oil properties. You get integration with their refineries, which, by the way, in the last little while has hurt them because the crack spreads, or the refinery margins, if you will, have gone down. But we think that the refinery margins have stopped going down, and if anything, are going to go back up. But also, Synovus bought refineries in the U.S. which were not very well managed. And we believe it's taken them a little bit longer than the market thought to turn them around to peak optimal performance. But we think that right now they're in that sweet spot. And lastly, they are almost there to getting to their sweet spot of $4 billion of net debt. And when they do that, they're going to be able to increase their share buybacks. And so a lot of cash flow will be able to be directed towards share buybacks, which is going to definitely increase the cash flow and earnings per share. And lastly, they just increased their dividend yet again. So you're getting a pretty nice yield on an $18 stock. I think it's 80 cents a year, which is something like 4.5%, 5%, which is not bad while you wait.
Okay, and do you think the price of oil will rebound a little bit?
We think so. We think the back half of the year, you're going to see a much higher price.
Got it. Okay, Mike, we do have to leave it there. Thank you very much for coming in. Appreciate that.
Thank you for having me.
We'll see you again soon. That's it for us on Market Call. Thank you for joining us today. We'll see you again tomorrow. A quick look at the markets as we head to a break.